What's up, superstars? Back with another video. You got Superstar Rob and you got Superstar Nation. How you guys doing? Oh man, beating me up every single day. If you haven't already, don't forget, become a superstar, smash the subscribe button, join the Superstar fam, hit the bell notification button to get every single video every single day. Also to our VIPs, thank you so much for your support. $2.99 a month at Star Massage Name Master Appreciate giveaways. Guys, reach out to us anytime on X, Instagram, or Discord. Make sure you join the Discord. The link is in the description below. In that Discord right now, Rich is running a security challenge, our security mod. If you can complete his weekly tasks, you will get entries into a chance to win some pretty cool prizes. You also get entries at week 5. You're going to have an ultimate security challenge where you may get some even better prizes. So make sure you guys join the Discord and you can learn and ask more there once you're in there. It's a tier-based model. So the more people that participate, the more prizes will be given away. Right now we've hit tier 2, which means that's 11 in total. That's at least 11 entries in total. We want to get over 26. So make sure you guys participate and join, and you can hit the description below to join the Discord. Okay, so guys, I'm on a tear right now when it comes to personal finance. It's an interest of mine. Markets are a big topic right now, so it's a hot topic. So I want to talk a little bit more about it. 2 days ago, I think I did a video about what works on Wall Street, which is this book right here that talks a lot about base rates. It talks a lot about how to invest with models, with data, a data-driven approach to invest with models. But I want to just show you guys how you can actually put that into motion. It's nice to read a book about this, but when you're done the book, it's like, well, how do I even do this in the first place? So I've come up with a way here, and it's a pretty popular website. Everybody should really get to know this website. It's called Portfolio Visualizer, and it's free. That's what's great about this. You just have to sign up, and it's totally free. And Portfolio Visualizer is a way to try and back test our strategies to see if it's actually going to work when we implement it. So if you go into Portfolio Visualizer, here's an example of just a basic model. This is not one that I don't think I made this one. I think it just came with it. If I did make it, I must have found it somewhere online. But it talks about 40% in the total stock market, 20% in Vanguard total international stock index, 10% in real estate index, and 30% in Vanguard total bond market. So you got a mix here of some equities. It's kind of like an 80-20. But that 80 equity is spread out between real estate, international stocks, and total stock markets. And in the end, we see our base rate. We see what's our return. Our CAGR is 8%, right? So this model, when back tested, returned an average of 8% per year. It also showed that you had it with standard deviation of 12%, which means it could swing around that 8% return by 12%. That's the volatility, right? So that's your median range. That's your mean range between 8. So 8 minus 12 is -4, up to 8 plus 12 is 20, right? So on average, you're somewhere between that 8 to 20. And your max drawdown is 22%. So we're learning now that if someone did want to implement this model and they said to you, this is going to work, trust me, bro, this is going to work. Well, this is how you prove it. This is how you prove it's going to work. You use a website like this that'll actually backtest it. Here's an example, one that I personally use. TD US Equity Index, TD Capped Composite, which is Canadian, and TD International. So these are just TDAM ETFs. I like them. I think they just do what they're supposed to do. And it's 40% in US, 40% in Canadian, and 20% in international stocks. This one here has a return of 10.8 with a standard deviation of 12.6. So a little bit better returns with relatively the same standard deviation. Max drawdowns 17%. One thing to note is the benchmark. The benchmark I'm using right now is actually SPY. So if you were 100% invested in SPY, you would do better than this model. With that being said, will SPY continue to tear the way that it does over the next 5, 10, 15 years? And that's why sometimes it's best to still spread out your investment, possibly over not just US equity, but other forms of equity as well. So this is a good start because now we've back tested it and we're like, okay, we know that this model has proven historically of working. We know that buying these specific ETFs as kind of our team and our horses to ride us into the future, it has shown us that it does have a good chance of success. But we don't really know our base rates because this is just these last 5 years. This is let's just say, for example, we are going to expect that 10.8% is in line with what we should get. If you research, what equities typically produce over the long run, you find usually 10% with inflation adjustment down to 8%. This website has another tool called a Monte Carlo simulation. Using Monte Carlo simulation, you can actually input here. I'll just go through this. You can input the tickers. My initial amount, I put $10 just to try. And in this strategy, I am going to contribute $1,000 monthly. Okay, this is the strategy, $1,000 monthly. I want it to be inflation adjusted. I want to simulate over 15 years because that's my time horizon. And I'm going to have parameterized returns, meaning I expect, and this is exactly the data I got from my first back test, when it asks what is my expected return, well, it's 10.8%. Why? Because I back tested it. And I know that that's the number. Also, what's my volatility, which is my standard deviation? Well, I back tested it, so it's 12.6%. So I can put that in here. Then the risk-free rate is kind of like, if you go and get like a government bond, it's a guaranteed risk-free return on your investment. So the risk-free rate, I'm going to put 4%. You could do better right now, but I'm going to do 4% because I think it's going to come down, and it might even go lower than that. But let's just say it is that for now. That's just the real return because you want to be able to beat your risk-free investment. That's the point here, right? Even if you made that zero, it wouldn't make a big deal. So if you run the simulation, what you get now are percentiles. So imagine running the simulation 1,000 times. So it's called the random walk theory, right? You have you have a mean, which is your 10.8%, and you have a standard deviation. Imagine you simulated the model so many times, thousands of times, and every time you did that, you just randomly picked a number between, remember I talked about -4 to +20? You just randomly pick numbers in between there, right? But you distribute it in a way that's kind of like a bell curve, in which you're most likely going to be hovering around that mean of 10.8. And then you get your base rates from this. And this is what I was talking about for my last video. And this is exactly what this book is doing. Expected annual return. So we know that in the 1-year range, you can see here, in the 1-year range, on the low 10th percentile of simulations, we actually had a loss. On the highest 90th, we had a gain of 27%. And somewhere in the 50th in the middle, we're around 10%, which makes sense because in 1 year, we're expecting to do this. But over the long run, you're going to see how these things change because down here, it says annual return probabilities. And you can see that what's the likelihood in the long run of returning more than 5%. And you can see as the years go on, my odds go up. So that from 1 year, I might have a 66% chance, up to 10 years, 90, up to 15 years, 94%. So what I'm seeing is the longer I stay invested with this model, the more likely I am to make money. And then if I want to make more than 10%, my odds are actually 50-50 with this model. It's not, we all know nothing's guaranteed. Everything is prediction. Everything is historical. But if I'm thinking going to this model with inflation adjustment, I'm going to make more than 10%. I only got a 50% chance of that. And then 80% chance at 7.5%, but more than 5%, I got a 95% chance. So my odds definitely go up with time. And the nice thing about this is that they also have a loss probability. And what you see is as time goes on, the likelihood of a loss is very, very low with this back test. So this is a way that you could actually put into motion this book, because now I'm actually using data and science. It's not real science, though. It's basically still throwing a dart with some of the assumptions I made, but there's a method to the madness. I picked a strategy of ETFs. I back tested it. I know my CAGR. I know my standard deviation. I run a Monte Carlo simulation model, and this is what I get. A bell curve of my likely returns. I can get potentially up to 850,000 doing this model of 1,000 a month for 15 years. But most likely, based on my model simulation, I'm going to be in this $450,000, $500,000 range over that time period, which is pretty good. And that's the power of dollar cost averaging. That's the power of compounded returns. And then in terms of a max drawdown, I'm not even taking, in my opinion, that much risk because I'm most likely going to be in the ballpark of a max drawdown between 18 and 16%. Now, we all know there could be black swan events. It's not there's been a time in history where the stock market dropped 80%, for example, right? It could happen. But the markets have always come back. So we got to, it's better. Not investing at all can be more riskier than investing. And a model like this, in my opinion, when you start seeing these base rates, when you back test it, you start seeing that this can be successful, that in the long run, your odds are like 94%. It's not actually going to the casino because the casino has the odds in their favor. When you do things like this and you know with confidence you're doing a model backed by data, which you have high odds of success, 94% chance of success in 15 years, 90% chance. I mean, heck, it's even at a casino, you have 66% chance on a game. That's pretty good. You can't get that. You can't get that there. And that's in the 1 year mark. So when you do things like this, you have more conviction, in my opinion, with your investing strategies, right? If you're an investor and you're doing things like this and you have data backing you up and you understand that you don't have a 100% chance of making money and you understand your range of where you're going to land with your returns, you may not bail out too soon. You may not get spooked when there's a market dip. You may not get spooked when there's a recession. You will stick to your strategy because you know in the long run you've tested it through the ups and downs. This includes the pandemic down. This includes the rebound. The last couple of years have been very, very good. So when you do this, I think you can invest with a lot more confidence. Of course, none of this is financial advice. I'm not promoting any of these ETFs. But what I am saying is that maybe if you don't do this already, you should consider using back tests and models in order to help you choose the right strategic approach. It doesn't stop there. You can even do this with asset classes. You can do this with Bitcoin ETFs, right? Maybe that's a good video I should do, actually, talking about could this work in the future? And I'm sure it's going to do very well because it's done great already. So guys, let me know in the comments below, what do you guys think about using this data to invest confidently, about actual real base rates, putting this book into motion? I want to hear your thoughts. Let me know in the comments below. If you haven't already, don't forget, become a superstar, smash the subscribe button, join the superstar fam, hit the bell notification button to get every single video every single day. Also do superstar VIPs, tournaments, superstar games, especially giveaways, guys. Thank you so much. Take care. See you next one.